Okay, guys, we need to discuss this part, claim of lenders and owners. Right. So, who are the lenders of a company? Basically, those who lend money. Basically, those who invest in the company's bonds are basically lending to the company, and banks also lend money to the company, right? And so, banks, bondholders, we call them as lenders, or we can call them as debt holders, right? So we are going to use the term lenders and debt holders interchangeably. They are the same, right? And who are the owners of the company? The owners of the company are its shareholders, right? So what are the claims of the debt holders? That is the lenders, and these lenders include banks who've given loans to the company, or bondholders who bought bonds that have been issued by the company, right? And what are the claims of the shareholders of the company, right? So let's understand this. See, so debt includes any bonds that the company has issued, or any loans that a company has taken or borrowed from a bank, or some other financial institution, right? So payment of interest on debt is a contractual obligation, right? So uh, a company is legally bound to pay interest on the loans that it has taken from the bank, and it's legally bound to pay coupon on the bonds that it has issued. Right. So if the company does not pay interest on the loans that it has taken, it does not pay coupon on the bonds that it has issued, then the lenders, bondholders can drag the company to court. So payment of interest is the topmost priority for a company that has borrowed money. In fact, payment of interest on debt has priority over payment of dividends to equity shareholders. Right. So what this means is that, say, this is the cash of the company. Now with the cash available, the company is first going to use this cash to pay interest to debt holders, to these banks, or to these bondholders, right? And whatever remains after paying interest can be used to pay dividends to common equity shareholders, right? So the idea is payment of interest has priority over payment of dividends to equity shareholders, right? Also, at the time of liquidation, principal owed to bondholders and other lenders are repaid before equity shareholders, right? So if the company is going into liquidation, then bondholders and other lenders would be paid before equity shareholders, right? So if we think from the investor's perspective, whoever has invested in the company's debt, he's facing less risk, right? So the bondholders who have invested in the company's bonds, that is the company's debt, and whoever has lent money, whosoever bank has lent money to the company, is facing less risk than the equity shareholders. Why? Because payment of interest has priority over payment of dividends. And the second thing is that at the time of liquidation, these debt holders, these bond holders, these lenders are going to be repaid before equity shareholders, right? So that is why, from the investor's perspective, debt is a less risky investment than equity. And since investment in debt is less risky, it also carries a lower return than investment in equity, right? So if so I'm talking from the investor's perspective right now, right? uh, so if an investor invests in a company's debt, that is, if he buys bonds, or maybe if a bank lends money to the company, uh, these lenders and these bondholders are facing less risk than someone who's investing in the equity of the company. Again, I've told you those two reasons, that payment of interest has priority over payment of dividends. And the second reason is that at the time of liquidation, bondholders and other lenders are going to be repaid before equity shareholders, right? So debt carries less risk from the investor's perspective. So whosoever invests in the company's debt is going to face less risk, and since he faces less risk, is going to get a lower return, because risk is proportional to return. Lower the risk, lower the return you get. Higher the risk of investment, higher the return you get. Right. So debt from the investor's perspective, not from the borrowers, but from the lenders. Right. Investor and lender are the same person. So from the lender's perspective or the investor's perspective, uh, debt has lower risk compared to someone who invests in the company equity, right? And that is why return on debt, that's someone who invests in the company's debt is going to get a lower return compared to someone who invests in equity, right? Because debt is less risk. Okay. See, since investment in debt is less risky, it carries a lower return. Now, the other way of saying the same thing is that the company, the borrower, has to pay less to those who invest in the company's debt, right? It has to pay less to those who had invested in the company's debt, because debt carries a lower risk. So if we think from the company's perspective, cost of raising debt is going to be cheaper than the cost of raising money through selling equity, right? See, from the company's perspective, cost of raising debt is going to be lower, because since debt is less risky investment, it's going to carry a lower return. Investors would settle for a lower return from a debt investment because it carries a lower risk. And what it basically means that is, when the company, the company can raise debt at, it can raise money by issuing debt at lower rates, right? Compared to equity investment, right? So what this means is that from the company's perspective, cost of debt is less than cost of equity. Cost of raising capital using debt is going to be less than the cost of raising capital using equity. And the simple reason is because debt, from the investor's perspective, debt carries a lower risk. Lower risk. So investors settle for a lower return from any investment in debt, right? Which translates, which when we think from the company's perspective translates into uh, translates into a lower rate of companies have to pay less to raise debt than equity. They have to pay less to raise debt than equity, right? So this is the whole idea, guys, right? This is the whole idea. From the investor's perspective, debt is a less risky investment. Okay, any doubts here, guys? Anyone's having any doubts? Yes sir or no, please? Any issues? You can ask me now. Yes, any issues? Yes sir or no? All good, guys? L1,
Yes,
L2, L3, all good. Okay, now there's a key difference between the upside and the downside potential of a debt and an equity investment, right? Okay, now we are going to talk of the upside and the downside potential for equity investments and debt investments, right? So let's talk of the upside and downside potential of equity investment. So I'm not talking of from the company's perspective who's raising money by issuing equity or debt. I'm right now talking from the investor's perspective, right? Whosoever has invested the money in equity, whosoever is invested in the company's debt, not from the company, not from the company's perspective. I'm talking from the investor's perspective, right? So, see, let's talk of the upside potential for debt, right? So, the maximum upside potential or the maximum gain for the for someone who invests in the company's debt is capped. Maximum gain to someone who's invested in the company's debt is capped, right? um, it's the maximum gain is limited to the extent of receiving interest and principal. Now think of a bondholder. See, bondholder is an investor in the company's debt, is a lender to the company, right? So if a bondholder invests in a bond, the max he will get is coupons during the life of the bond. So it's a 4-year bond, um, and it gives a 4% coupon annually, and has a face value of $100, then this bond is going to pay $4 at the end of every year for the next 4 years, and it's going to pay the face value at maturity. Right. So this is all that a bondholder is going to get. If the earnings of the company increases, if the earnings of the company increases 2x, 3x, right, or there is a uh, there's a 10x increase in the company's earnings, the debt holder still gets this. He does not get more, right? So the maximum gain or the maximum upside that a debt holder enjoys is going to be capped. Um, it's going to be limited, and it's going to be limited to the extent of receiving interest and principal, right? Um, but investment in equities, so someone who's invested in the equity of a company, he enjoys an unlimited upside potential. His maximum gain is going to be unlimited. Why? Because, see, understand, there is no cap on the price of a stock. Stock prices can rise without limit, right? So their upside potential is, someone who invests in the company's equity, his maximum upside is unlimited, right? His maximum gains are unlimited. There is no limit on the kind of gains he can make, right? So what we can understand from this, that the upside potential on debt and equity investments are limited. Equity investments have an unlimited upside potential. That means that the maximum gain to someone who invests in the company's equity is unlimited, and the maximum gain to someone who invests in the company's debt is capped. It's limited to the extent of receiving coupon and principal, right? So the upside potential for equity and debt investments differ, but their downside is the same, right? Downside is the same, right? The maximum loss for equity and debt investments are similar, right? So their maximum loss for the equity and debt investors. So the maximum, yeah. So what I was saying, I have to make it again. Debt, capped, equity, unlimited, upside. I'm talking from the investor's perspective, and now I'm going to talk from downside. Now, the downside potential or the maximum loss for equity and debt investments are similar. The max loss for debt and equity shareholders is limited to the amount that they have invested in the company, right? So, let's speak of the debt holders first. If the company goes bankrupt and defaults in paying coupon and principal to debt holders, or defaults in paying interest and principal to a bank, then the debt holders lose their entire investment. Their maximum loss is going to be a minus 100%, right? Um, and think of the equity shareholder. So if the company goes bankrupt, its stock price is going to come down to zero, and equity shareholders also lose whatever they had invested, right? So the maximum loss for both equity and debt investors is their investment, right? Maximum loss is whatever they had invested in the company, right? So that is why we say that their maximum loss is limited to the amount that they have invested in the company, right? So when I see, what do you mean by the maximum loss is whatever you invested in the company? This is a gentle way of saying that you can lose everything you invested if you invest in equity and debt, right? So so when I say that you can lose everything that you invested, it does not, it sounds like really scary, right? It it sounds like it's like really really scary, but when I say that your maximum loss is limited to the amount that you invested, it does not sound as scary, right? But both of them mean the same, right? Maximum loss is limited to the amount that you invested does not sound so scary, but when I say that you can lose everything that you've invested, it sounds like really scary. But both of them mean the same, right? Both of them mean the same. Okay, so this is the idea. This is the idea. The downside or the maximum loss for equity and debt investors is the same, right? They can lose whatever they had invested, they can lose the entire amount that they had invested. But upside potentials differ. Someone who's invested in company's equity, his maximum gain is unlimited because there's no cap on the price of a stock. Stock prices can rise without limit. But someone who's invested in the company's debt, his maximum gain is limited to receiving interest and principal on time, right? So, given this situation, will equity investors want company take more risk, or will debt investors want that company takes more risk? Guys, who will want that the company takes more risk? Guys, who will want that the company takes?
Equity investors.
Hmm? Okay, so the idea
The
is that,
idea is
see these debt holders, their maximum gains are capped, right? Uh, but their downside is similar to that of the downside that equity investors are going to face, right? So debt holders would want that company does not take much risk. The company's cash flows remain stable, its earnings remain stable, so that these debt holders get their interest and principal on time. So they don't want they don't want that the people who borrowed from them take a lot of risk. They don't want the company to take risk because the you know if those risks pay off and the company earns a lot, that's not going to make a difference to the debt holders, right? They still get their coupon and they still get their face value, right? So if earnings go 10 times, 20 times, 30 times, uh, those higher earnings you know will not be enjoyed by the debt holders. They still get that fixed interest that they get, right? So even if the company takes those risks and those risk payoffs, debt holders are not going to benefit. So they don't want company to take a lot of risk because all if those risk even if those risk pay off, they all they get is that interest, right? But equity shareholders will want the company to take risks because if the company takes risks and those risks pay off, then the company's earnings are going to rise, and if the company's earning rises, then its stock prices are going to rise, and if stock prices rise, then equity shareholders are going to make a lot of money, right? So the equity shareholders would want that the company take a lot of risk, right? So the prima facie idea here is that downside for both equity and debt investments are the same, but upside for equity investments is unlimited, but debt investments is capped. So equity investors would want that the company take a lot of risk. Debt investors won't. They would want that company does not take risks, remains more or less stable, and pays interest and principal on time. Right? Guys, are we clear with this idea? Any issues? Guys, anyone's having any issues? Yes or no? Please.
no, sir.
All good. L1, L2, L3. Guys, L1, L2, L3. All of you guys. Guys, please tell me any doubts. Okay, so more or less we are good. Nothing to worry about. Okay, now let's see. Now, guys, just look at the P&L of the company. See, how does the P&L look? So, P&L of the company starts with sales figure, right? Uh, from your sales, you deduct your cost of goods sold. From your cost of goods sold, once you deduct cost of goods sold from sales, you get the gross profit. Then you deduct all the operating expenses of the company from your gross profit, and you get your operating profits, that is interest before interest and earnings before interest and tax. Earning before interest and tax is a proxy for operating profits. And from your EBIT, or your earnings before interest and tax, you deduct interest. This gives you your profit before tax. And from your profit before tax, you deduct taxes. And this gives you your profit after tax, which is also known as the net income. This is how a very simple income statement is going to look like, right? Now see this interest that you pay on debt has already been deducted from your net income, right? So while calculating net income, we've already deducted interest, but we've not deducted the dividends that we pay to equity shareholders, right? So since whatever we owe to the debt holders has been, whatever we owe to our debt holders, that is interest, has already been deducted from net income. Net income of the company, part of the company, is not available to the debt holders of the company, right? Net income is available to the equity shareholders of the company only, right? It's available only and only to the equity shareholders of the company, right? And see, with the net income of the company that is available for distribution to equity shareholders. Now, so this net income is available for distribution to the equity shareholders of the company. Now, with the net income, you know, the management of the company can do two things. What two things can be done with the net income? So, net income is not available to debt holders, it's available only to the equity shareholders, or to be more specific, the common equity shareholders of the company. It's available for distribution. Net income is available for distribution to the common equity shareholders of the company. So, what can be done with this net income? As only there are two uses of this net income, right? These what can happen with net income is that the company can either distribute the net income as dividends to equity shareholders, or it could retain them and reinvest in the business, right? Retain and reinvest. These are the two things that can be done by the management. And remember, this net income is available for distribution to common equity shareholders and common equity shareholders alone. No one else, not to debt holders. Right. Okay. So, if the management of the company has identified viable investments with good growth potential, then they are going to pay less dividends, and they are going to retain most of these net income to reinvest in these viable investments, right? And these reinvestments are going to fuel future earning growth, right? And on the flip side, if there are no viable opportunities in sight, then the management can choose to pay out the majority of the net income as dividends, right? So payment of dividends depends upon uh, whether the management has viable opportunities in sight, right? If the management has identified viable opportunities, investment opportunities, then what they are going to do is that they are going to retain a lot of this net income and reinvest it in business, not pay them out as dividends. But if they have no viable investment opportunities in sight, then they might choose to pay out the majority of the net income as dividends, right? So with this discussion, what we conclude is that payment of dividend depends upon whether the management has identified viable investment opportunities. Right. So, what are the few things that you can understand from this particular thing, from this particular discussion? First thing that you understand is that payment of dividends is payment of dividends to equity shareholders is discretionary in nature, right? Or you can say it's variable in nature, and it's going to depend upon whether the management has identified suitable investment opportunities, right? However, payment of interest is compulsory. Payment of interest to lenders to borrowers, payment of interest to lenders to bondholders is compulsory, right? In fact, it's a contractual obligation, it's a legal obligation. So if you don't pay interest, if borrowers don't pay interest on the loans that they've taken from the lenders, then the lenders can drag them to court, right? So payment of interest is compulsory in nature. It's a contractual obligation, it's a legal obligation, right? The second thing that we're going to understand is that if these earnings rise, if these earnings say double, triple, or if they grow 10 times, then only the equity shareholders are going to benefit, because this net income is available for distribution only to the equity shareholders of the company, right? The debt holders are not going to benefit out of this, because even if earnings double, then the debt holders still get that fixed interest, right? The net income is not available to them, it's only available to the equity shareholders, right? So if the value of the firm increases, it's going to benefit the equity shareholders, it's not going to benefit the debt holders of the company. This is a very important point. So if the value of the firm increases, it's going to benefit the equity shareholders, not the debt holders. And the last point that we need to understand here is, see, that I told you that from the company's perspective, because from the company's perspective, cost of raising debt is cheaper than equity. Cost of raising capital by selling equity. Right. So to reduce its overall cost of capital, the company would like to raise more debt and less equity. Why? Because that's going to reduce the overall cost of raising capital, right? Company would like to raise more debt and less of equity, because cost of raising debt is cheaper, because debt investment is less risky than equity investments, right? Company has to pay less to raise debt, because debt is a less risky investment. So companies would like to raise more debt. But see, this comes with a catch. This particular statement comes with a catch. And what is the catch? What is the catch? Payment of debt, interest on debt is compulsory, but payment of dividend is variable, right? So companies would naturally like to raise more debt, because cost of raising debt is cheaper. But see, notice here, if the operating profits of the company, see, interest is being paid out of the operating profits of the company, right? If operating profits, that is the EBIT, falls below interest, that is, if the operating profits are not sufficient to make interest payments, that is, if operating profits are less than interest, then the company won't be able to pay interest. It won't be able to service its interest obligations, and it might go bankrupt, or it might be declared a defaulter. So, see, if you raise more debt, you might end up in a situation where your operating profits are not sufficient to meet interest payments. And in such a situation, you might be declared a defaulter. People can drag you to court, right? So that's a big catch here. So you should raise debt to only to such an extent that your operating profits are sufficient to repay your interest, right? Your operating profits are sufficient to make the interest payments. This is very important point. Debt reduces the overall cost of raising capital, but it increases the risk of bankruptcy. It increases of the risk of the company being declared a defaulter. So you should raise debt only to the extent your operating profits are sufficient to meet the interest payments. Guys, are we good with these logics? Any doubts with this, whatever we've discussed? Guys, any doubts? Do we have any doubts, please? Yes or a no? Level 1, level 2, level 3. Guys, L1, L2, L5, L7. Okay, Shreya is okay. Shreya, Pulkit, Nimish, Mehak, Saurav. What about the rest? What about the rest? Suchi. Okay. Anmol, Bettina, Victor. Okay, so more or less we are okay. More or less we are okay. So, guys, can I say that, to summarize, what can I say that debt holders are primarily concerned with the debt holders? Can I say that, debt holders are primarily concerned with getting their obligations on time? They are not concerned with the growth of the company. While equity shareholders, they will like the company to take more risks to increase the earning potential. Can I say this, guys? Guys, can I conclude this claims of lenders and owners by saying this that
Yes.
yeah, so this is the idea. Then debtors don't want these debt holders don't want the company to take a lot of risk. They want that the company service its debt obligations on time. They are not concerned about the company's growth because even if the company grows 10x, 20x, 100x, we still get that fixed interest. Though that net income is not available for distribution to debt holders, it's only available for distribution to the equity shareholders. And see, if net income rises, then eventually stock prices are going to rise. Stock prices rise, equity shareholders are going to make money. So, equity shareholders are concerned with the growth of the company. They would want that the company takes a lot of risks because if those risks pay off, then the companies then they are going to make a if those risks pay off then the earnings of the company are going to rise which is going to increase stock prices, and if those risks do not pay off then their maximum loss is defined, right? They're not going to have unlimited losses. These equity shareholders are not going to have unlimited losses. Their maximum loss is whatever they've invested, right? So there is maximum upside potential, but um, the downside is has a floor, right? There's not an unlimited downside, right? There's not an unlimited downside. The downside has a floor. It's limited to whatever you invested. So they would want the company to take a lot of risks, right? Okay, so with this we've covered a lot of ideas. Now what we are going to discuss is corporate governance. Now what is corporate governance, guys? Any idea what is corporate governance? Guys, any idea what is corporate governance? Okay, so if you don't have an idea, you can read this slide. So it's the process or the practice that should be followed to balance the interests of the shareholders, senior management, directors, employees, customers, suppliers, government, and other people associated with the company. Right. So we'll call all these people the stakeholders in the company. All these people are known as stakeholders. Right, shareholders, management, directors, employees, customers, suppliers, lenders, and the government are the stakeholders of the company. And how would you define a stakeholder? Stakeholder is basically a broader term for any group of individuals which who know group of individuals who either affect the company or get affected by the company, right? So all these people either affect, they either they get affected by the company or they themselves affect the company. So these guys are stakeholders, right? And the primary goal of corporate governance is to reduce the conflict of interest among these various stakeholders. So primary goal is to reduce the conflict of interest among the various stakeholders. This is the primary goal, right? Okay. So these are the stakeholders: shareholders, director, management, employees, lenders, customers, suppliers, government. All these are the stakeholders of a company, right? These people either get affected by the company or they themselves affect the company, right? Okay. Now we talk of shareholder theory and stakeholder theory, right? Now, traditionally in the past, corporate governance practices were based around shareholder theory. Now, but now what's happening is that many companies are now moving to corporate governance frameworks based on stakeholder theory. In the past, corporate governance practices were based around shareholder theory, but now they are moving towards stakeholder theory. And what is shareholder theory? Now, shareholder theory states that the goal of the management is to maximize the wealth of the shareholders, the owners of the company. Maximize shareholder wealth. Shareholders are the owners. And the interest of the other stakeholders are considered only to the extent they affect the shareholders, right? So they are saying that you only think about the shareholder, don't think about the stakeholders, right? Think only about the stakeholders when they affect the shareholder wealth, right? But otherwise there's no need to think of the stakeholders. That's what shareholder theory says. Don't think of the stakeholder, just maximize the interests of just think of the interests of the shareholders. Now, what is your stakeholder theory? Stakeholder says that the company should consider the interests of all the stakeholders involved. Consider the interest of everyone. Consider the interest of all the stakeholders and not shareholders alone. And not just the shareholders. Not just the shareholders. Guys, are you making notes of this, whatever I'm saying? Is someone right? If it will be better if you write all this. Although recording is available, there's nothing to worry about. Guys, are we making notes of this? Yes.
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 Okay. Now we are going to talk of the various stakeholders, right? So, um, we're going to talk. I'm going to talk about shareholders, their rights, their responsibilities, and I'm going to talk of the rights, responsibilities, and interests of the other stakeholders of the company, right? So the lengthy ones are shareholders and directors. Let's talk of them first, right? So shareholders, right? First, let's talk of shareholders. I'm going to take this part in some when I talk of this in detail. Today, I'm going to give you a prima facie idea. I'm going to give you a general idea, right? So, when you buy equity shares of a company, right? When you buy equity shares of a company from an exchange, you are entitled to receive dividends and you also get voting rights, right? Again, payment of dividends is not compulsory, it's discretionary in nature, right? uh, but but once you buy equity shares of the company, you are entitled to receive dividends. So if the company declares dividends, you are going to get them. And you also have the right to vote, right? So you can vote on important matters that are of concern to the company, like you can vote on matters like appointment of directors, selection of auditors, compensation of senior management like CFO, CEO, and all that, right? And the number of number of votes a shareholder can cast is proportional to the number of shares he or she owns. Usually, there is one vote for every share that you own. So, if an individual owns a lot of shares of a company, he can cast a lot of votes, and he can literally direct the course of the company, right? Whatever he says is whatever his will is going to have an impact, right? His will is going to have a big impact if he owns a lot of shares, because that would mean that he can cast a lot of votes, right? And see, the idea is that even if so usually the idea is that there's one vote for every one share that you own. This is generally the idea, right? Now, there are tens and thousands of shareholders of a company, right? So the question arises is that how are the shareholders going to interact with the directors? How are they going to interact with the senior management of the company, right? How, see, there are tens and thousands and lakhs of shareholders for a very, very big company. So how are they going to interact with the board of directors? How are they going to interact with the senior management like CEO, CFO? How are they going to do that? Right? So what happens is that the directors, the management, and the shareholders of the company meet once a year, and so they gather once a year, and this gathering is known as the AGM, Annual General Meeting. It's conducted once a year, right? And directors of the company, in the annual general meeting, directors of the company are going to present the financial statements of the company, and these financial statements show the performance and position of the company, right? So these financial statements include your income statement, that is your profit and loss, your balance sheet, and your cash flow statement. These are the primary financial statements that the directors are going to present in the annual general meeting, right? Now this income statement shows the performance of the company in a given financial year. The balance sheet shows the what the company owes and what it owns, right? So the balance sheet is going to show the assets that the company owns and the liability that it owes. So it shows the position of the company. And cash flow statement shows that how the company has utilized its cash balances, right? How it has utilized its cash balances during the year, right? So they are going to present all this in the annual general meeting, right? The directors of the company are going to present this in the annual general meeting, right? Now, once they've presented this, once the directors have presented this, and shareholders get to ask questions to directors and the management about the financial statements or the company's operations, right? So they're going to ask, so if the company performed poorly, its profits went down, shareholders might ask what happened, why did they go down, what are the future prospects, are the profits going to go down in the coming years as well? What are the kind of revenue guidance? Are the margins of the company going to rise, or are they going to fall? So they're going to ask all these questions, and these questions are very, very important with respect to gauging the future performance of the company stock. Right? These questions are very valid. Though none of us ever attend a annual general meeting, but if we do and ask the correct questions, then we can get a lot of insight, and that insight will help us make more informed investment decisions. Okay. Also in the annual general meeting, what happens is that the shareholders are asked to vote on important matters, such as election of directors, um, you know appointment of auditors, dividend payments, all that, right? So they are asked to vote on this, right? So this gives you a broad idea of shareholders, right? The broad idea. This is just a broad idea. Now these are more advanced things. I'm going to talk of all this in the next class, right? Today I just want to give you a prima facie idea, right? I don't want to dig deep. Once you are good with this class, then I'm going to the next class. I'm going to uh, dig deeper into these topics. Right. Okay, so this is more or less a brief discussion on shareholders. Let's then talk of the directors. We've already spoken of this, right? I've already spoken of this. I'll speak of this later, right? Since I'm talking of shareholders, now I want to talk of directors. Okay, so see, in a very large company, there are going to be thousands or maybe tens of thousands of shareholders. So these guys are the owners of the company. Ideally, they should run the company. They are the owners. They should run the company. But it's not possible for these many tens and thousands of people to run the company, right? Because all these shareholders, all these tens and thousands of shareholders might end up fighting with each other, right? So if one shareholder does not agree with some other, then they're going to make groups and they're going to beat them up, right? So what these guys do is that they uh, elect board of directors, right? The shareholders are going to elect the board of directors. Shareholders delegate their power to the board of directors, right? And these board of directors are going to appoint the senior management of the company. The senior management of the company is basically the CEO and the CFO, COO, all these guys, right? All fancy names, right? Now, the role of the management is to oversee and direct the day-to-day operations of the company, right? So, see, what are board of directors are going to do? Board of directors are going to decide the strategy of the company. Business strategy is going to be decided by the board. Board is going to decide what business strategy the company is going to follow, and the senior management is going to implement that strategy. Right. So board is going to think, and this management is going to implement. Right. But the management is made up of all these very high-paying CEOs, CFOs, CEOs, all these large subs. So these people are not going to move their bodies to do all the work. What they are going to do is they are going to appoint employees, and they are going to ask the employees of the company to implement the um business strategy that has been decided by the board, right? So, and this management is going to oversee the activities of the employee, and the employees are going to carry the day-to-day activities of the company, right? So the hierarchy is such that shareholders elect the board appoints the senior management, senior management appoints employees. Board decides what business strategy the company is going to follow. Senior management is going to implement it, but they won't do it on their own. They won't move their, I don't want to name it, but they're not going to move that specific part of their bodies. They're going to appoint employees, and these employees are going to move their bodies, and they're going to do all the work, and the management is going to oversee the employees, right? So the board oversees the management, management oversees the employee, right? And it's the duty of the directors and the management to act in the best interest of the shareholders, right? So it's their responsibility that they should act in the best interest of the shareholders. They should take such business decisions that maximize shareholder wealth. Okay, so this is your director, right? Okay, now the directors of the company could be executive directors, also known as internal directors, or they could be independent or external directors, right? So who are these executive directors? See, when members from within the management or some senior employee is appointed the director of the company, we call him a executive or internal director. So if the CFO of the company is appointed as a director, we'll call him a executive director. If the CEO of the company is appointed as a director, is elected as a director, we're going to call him an executive or an internal director. Or if the COO of the company is appointed as the director of the company, we are going to say that uh, he's an executive internal director, right? So, executive directors, internal directors are elected from within the company, right? They are people who belong to the company, right? They are people who already have some kind of an established interest with the company, right? And then you have independent directors or external directors, right? So now, independent directors or external directors, or you sometimes call them as non-executive directors, they are also known as non-executive. These internal directors known as executive, and these independent or external are sometimes also known as non-executive directors. Now, these people do not have any business or financial relationships with the company, and neither are these people from within the company. So these independent directors are not going to be the employees or the management. They're not going to be a part. They're not a part of. They're not the employees. Neither do they belong to the management of the company. Right. So they are people from outside the company, and they're people from outside the company, right? And they are typically selected. These independent directors are typically selected because of their expertise, because of their experience, their reputation, right? And these guys are usually professionals in the field of finance, law, or they are going to be some solid academicians, right? They are going to be very great at academics and that kind of stuff. And because of this, they can bring a lot of they can bring a lot of value on the table. They can offer a lot of valuable perspectives and insights to the board, right? So these are your executive and non-executive, or these are your executive and non-executive directors. This is the idea, right? Guys, are we good with this, with the director part? Any issues here? Guys, anybody is having any issues? Please tell me. Level 1, level 2, level 3. Guys, any doubts? Yes or a no? Rest of you, only 4. Rest of you, what happened? See, guys, please, I keep on, I'm continuously talking. So, whenever I ask you for doubts, please ask me, right? Please ask me. If you don't hesitate in asking anything, right? Feel free to ask me. Okay. So now, guys, I'm going to, so a lot of theory can make things a bit boring. So I'm going to take one more topic, and then I'm going to uh, end today's discussion. Okay. Okay. Now, guys, the idea is that there can be two types of board structures. These, so the board of directors are made up of executive and non-executive directors. That is independent directors. Independent directors were also called non-executive, right? So the board is made up, comprises of executive and non-executive, right? Now, the board structure can be one tied, or it could be two tied. Two tied is sometimes also called a dual board structure, right? Now, see, in a one tied board structure, what happens is that the executive and the non-executive directors sit on a single board, right? These executive directors, which are people from within the company, that is people from the management, people from the employees. These are your executive directors, and non-executive or your independent directors are going to sit on the single board, right? So if any board meeting happens in a one-tied board structure, it will be attended both by executive and non-executive directors, right? It's going to be attended both by internal and independent directors. Right? See guys, understand this. These executive directors are people from within the company, right? So these executive directors are also maybe the CEO or the CFO of the company, right? These executive directors are people from within the company. Now, what's the job of the directors? The job of the director is to oversee the management. But when we talk of executive directors, they're also the management, right? So, what this basically means is that the executive director's job is to monitor themselves, right? Their job is to oversee themselves. And that's a bit shady, right? That's an abuse of power. It's an abuse of power. Executive directors are from within the management. They're chosen from within the management, right? They might be the senior employees, or maybe they might be the CEO or CFO, right? So the executive directors are themselves the management, and the job of the executive director is to monitor the management. That is, their job is to monitor themselves. So that's very cliche, no? That's a bit shady. How can I monitor myself, right? So if I do something incorrectly, I'm going to vouch for it that no, whatever I've done correct. There's no third party who's going to judge my actions, right? I'm going to so it's going to be like Big Boss, where no one admits that they are wrong, right? So it's going to be more or like that, be more or like something like that, right? How can a person monitor himself? How can he be? How can he oversee himself? Right? It's very difficult. Right? So what happens in a so in a one-tied structure? This is a problem. There's going to be some abuse of power because the executive directors are from within the management, and the job of the executive director is to monitor the management, which means that they have to monitor themselves, and that's more or less is going to lead to an abuse of power. So what happens is, to prevent this abuse of power, there's you know you know a two-tiered board structure is set up, or a dual board structure is set up, and here there are two boards. One is your management board, and the other is your supervisory board. Now, the management board is made up of executive directors, right? That is, directors who are chosen from within the management. And the supervisory board is made up of independent directors, right? Or your external directors. People who do not have a financial or a business relationship with the company. Those are your independent directors, chosen from field of finance, law, or academicians, right? These are your independent directors. And the supervisory board is made up of independent directors, right? Now what happens in this dual board structure is that this supervisory board is going to oversee the activities of the management board, right? So now there is someone who is monitoring the executive directors in this dual board structure, in this dual tied board structure, right? The supervisory board, which comprises of these independent directors, are going to monitor the management board, right? So this dual board structure is going to reduce the abuse of power, right? Guys, have we got this, please? Guys, have we got this? Yes or no? Please tell me. Any doubts, guys? Guys, anybody is having any doubts, please? I could have made this like really complicated, but I'm not. I'm just trying to speak in as simple language as I can, because corporate governance can get really painful at times, right? It can get really painful because at times we have a lot of laws to think of and all that. But I'm trying to explain this in as simple a language as possible, right? As simple. So I think we have no doubts. All of us are okay. Saurav, Suchi, uh, Shreya. Mansi. Rest of you guys, Anmol, Mehak, Nimesh, Pulkit, Anmol, Bettina, Victor, Mabel, Saurav, Saurav, all okay? Yeah, all okay. So, yeah, so this is the primary idea, guys. So, so this is theory, and more theory. So I'm not going to bug you more with theory, right?